All right. Well, last time when we were together, we were chatting about estate planning and some of the basics that need to be considered when we're putting that into place. And so today we want to step that up and talk about some more advanced estate planning techniques. And these are things that generally are applicable to larger estates. We kind of think on when there's more money, there's more problems. And I can think of a better way to sing that, but I'm not going to. I'm Valerie Escobar with Mariner Wealth Advisors, and you're listening to Your Life Simplified. Today, I am joined by Ben Voelker. Ben, thanks so much for joining us again.
Great to be back.
Ben, thank you for helping us understand this more complex step of estate planning. Maybe when we get into this, what we are really trying to avoid is huge estate tax problems. And so what situation would warrant somebody having an estate tax problem?
Yeah, so I think it's important to understand what the estate tax landscape looks like today and where it may go in the future. So right now, the federal estate exemption, which is basically the amount that you can pass tax-free to individual beneficiaries, typically your children, is set at $12.92 million per person. So if you're a married couple, you have just shy of $26 million that you can transfer federally tax-free to your heirs. Any amount above that is subject to a 40% transfer tax at the federal level. Now, at the state level, every state is different. Some states have no estate tax. Some states have estate tax with lower exemptions than that 12.92 million. So a customized conversation with your senior wealth advisor about your particular needs is important. But at the federal level, which we're all subject to as citizens, that 12.92 is the magic number. Frankly, that number has taken estate taxes as a concern off the table for many because of how large it currently is. The way the tax law is currently written is that number will be indexed for inflation between now and the end of 2025. So next year and the following, we'll have a slight increase to that 12.92 million. But assuming no future tax law is passed, in 2026, the Tax Cuts and Jobs Act, which was passed in 2017, it sunsets, which means it goes away. And the impact that it has on these estate exemptions could be substantial. We don't know exactly what they would go to because we can't predict with certainty that inflationary adjustment over the next 2 years. But back of the napkin math, it looks to go down to between 7 and 7.5 million per person. So rather than having 26 million of exemption as a married couple, you may have 14 or 15 million of exemption available to you. So a loss of $10+ million of that exemption.
Okay, so today what we're really focusing on, or at least on this specific topic right now, what we're talking about is if you have an estate, so all your net worth is more than, as a married couple, 26 million. So you might have a tax problem if you die right now and you have $30 million worth of an estate. And then after 2026, my $30 million estate tax problem is now going to be really big because if the new exemption amount is 15 million. Before I was worried about, the difference between 26 million and 30 million. So that $4 million of taxable estate. Now let's do some math for me, 15 to 30. So now I'm worried about $15 million worth of tax, correct? Am I understanding all that correctly?
You are.
Okay.
And I think that also puts another group into consideration. And so maybe I'm worth, my wife and I right now, 10 or $12 million, right? Mm-hmm. So we don't have an estate tax problem today, but we're relatively young. We expect our assets will continue to grow over time. And if those exemptions go down as scheduled, we're going to have an estate tax problem to deal with in the future, even though if you looked at our balance sheet today, you wouldn't see that on the surface.
Okay. Yeah. So, the population is growing a little bit as we're diving into this. But help me understand a few terms. If you go and you Google estate tax problems or something like, you'll get all sorts of terms. And so the biggest, I think the most common are there's a federal estate exemption, the generation skipping transfer trust, and the lifetime gifting exemption. So these are three terms. What's the difference? What do they mean?
Yes. So federal estate exemption, that's the 12.92 million today that we just
Mhm.
shared. So that's tax-free transfers at death for each individual. So I have 12.92, as does my wife. The generation skipping tax exemption, and I really don't like this term because it's intuitively confusing. First, it's the same 12.92 million, so the number is the same, but it does not mean that I am going to have additional tax imposed by giving assets past my children directly to my grandchildren. That generation skipping tax exemption, the way it's most frequently used is at my passing, I create a trust that initially benefits my children. And I apply that generation skipping tax exemption to the trust up to $12.92 million dollars of funding. That trust is going to provide for my kids. It will be invested and it will grow over their lifetime. And when my child passes, that trust that I left for them, initially funded with less than 12.92, and all of that growth over their lifetime, that will transfer to their heirs, my grandchildren, without being subject to estate tax in my child's estate. So when we work with families where mom and dad have been very successful and those children are very successful in their own right, building their balance sheet, the use of that generation skipping tax exemption is incredibly important. Because if I just left assets directly to my child, it now becomes part of their taxable estate. And when they pass, potentially subject to tax. But if I leave it in that generation skipping tax exempt trust, that asset and the growth will not be taxable when they pass. So what we're really trying to do with that generation skipping tax exemption is maximize the impact we have to our grandchildren and minimize the amount that would go for the taxing authorities. And the
Perfect.
last
And
is I'm sorry, go ahead.
no, I was going to say the last one was lifetime gifting exemption.
Yes. So again, the numbers are the same,
Mm-hmm.
12.92. So there's two ways that we can use that estate exemption. One is by gifting during our lifetime, and one is by transfers at death. So, for instance, Valerie, if while I was alive, I decided I wanted to give my child $1 million so that they could purchase a home, and I just gave it to them, right? I've used $1 million of my gift exemption because I provided it to them during my lifetime. Now, at my passing, my federal estate exemption has been reduced by that $1 million gift. So instead of $12.92 million today, I would have $11.92 million.
Perfect. And so all three of these terms they have as of today have the same dollar amount tied to them, but they are pretty different into what they do. And so thank you for clarifying those. Um,
Absolutely.
and as we're talking about this, that I can gift right now. I can gift $1 million, or I can wait until I'm on my deathbed, not even at my death, but when I die, my estate plan will then dictate where that money goes. And so now let's say, okay, I'm going to plan ahead because $1 million today will be a lot more when I actually die. And so we are now thinking of some strategies. So what are some potential strategies people could implement that are in this estate situation?
Sure. And a lot of these strategies are what we're working with clients on as we look to
Mm-hmm.
what might happen in 2026. So, as I just mentioned, there's two ways to use this exemption, right? The 12.92 million higher than where we expect it to be in the future. The first, and honestly, I've not found a single client excited to use it this way, is I could die. If I die and it's 12.92 million of exemption, I know what that tax-free transfer to heirs would be, right?
That's weird.
However,
Yeah.
yeah, again, not strategically something our clients seem to be interested in. So the other way that I can lock in these higher exemptions is to make a gift. And if I would gift the full $12.92 million, I lock in the higher exemptions we have today. And now I've taken the tail risk of what could happen in 2026 and beyond off the table because I've basically banked my 12.92 million. Now, the reality of the situation is if you're worth $250 million, it's a really easy decision to make. I'm going to gift 12.92. My wife's going to gift 12.92. There's some rules that we have to be cognizant of if we're both doing it, but that's not impacting lifestyle because
Right.
25 or 26 million off an asset base of 250 isn't going to change what we spend, what we do, how we behave. The majority of the clients we work with and the population doesn't sit in that net worth stratosphere. And so
Hmm.
when we're looking at someone that has a net worth of 25, 30, 40, 50, they may really like the idea of locking in these higher exemptions. But there's a concern that if I earmark these assets now for my children, what happens to us if we don't retain sufficient wealth to provide for our needs and potentially for medical care later in life? So the vehicle that we see used most frequently, and this is exclusively for married individuals, in
Hmm.
order to create flexibility around this gifting structure, is what's called a spousal lifetime access trust. In estate planning, we come up with stupid acronyms for absolutely everything. We call this a SLAT, right? In a SLAT structure, one spouse, let's say me, makes a gift into trust for the benefit of their heirs. So ultimately, it's going to be for my children and subsequently my grandchildren. However, my wife can be a permissible beneficiary of that trust as well. Now, we certainly don't want to have to distribute assets to my wife as a beneficiary because hopefully we've retained enough for our lifestyle. But if something unexpected happens and we need to draw from that trust, she, as a beneficiary of that trust, can get the distribution. And spouses can share money interchangeably, either during life or at death without tax
Hmm.
consequences. So once she gets the distribution, I can indirectly benefit because she could bring those assets back together. So that's a way
Perfect.
for us to lock in these higher exemptions. The assets are removed from my estate for estate tax purposes, but we have a safety net that if we do need to get assets back, there's a way to do that. I do always say it should be a safety net, not a game plan. If we really think we're going to need those assets, we have to revisit, does our financial plan support us giving away this amount of wealth, and make sure that we're doing it in conjunction with what our income needs are expected to be in life. But this structure is flexible. There is risk, right?
Yeah.
There's risk that she would pass away prematurely, and if she's not alive, she's not a beneficiary of that trust. And so
Hmm.
now it's exclusively for the benefit of my children and grandchildren, and I cannot access it. Sometimes we plan for that risk by having life insurance, term life insurance on my wife, that if she would pass in the first 10 or 15 years, there would be a death benefit that would provide liquidity for me if needed. The
Hmm.
other risk, and I hope it's not a risk in my family, knock on wood, is if we're not married at the time when she takes a distribution, one, she's
Hmm.
probably not going to be willing to share it with me. But two, there's tax consequences because that distribution of wealth between spouses only applies to married individuals. And so,
Right.
as uncomfortable as it sometimes may be, a conversation about marital bliss is an important consideration when you're looking at that type of planning.
Right. And so the spousal part is not, it's accessible because they're spouses, but it's if you give it to your wife and your wife is no longer your wife as a person, it's still tied to her, correct?
Correct.
So
She can still get
she could still have
distributions.
access and then go and gift to her new boyfriend, which she would never get. But
Yeah, yeah. Her next husband would be very well taken care of in a situation like that.
okay, so something definitely to be cognizant of.
Yeah,
Okay, and so spousal lifetime access trust. Give me another idea. What
sure.
would be other ways to help reduce your estate?
Sure. So, I mean, we talked about gifting to lock in these higher exemptions.
Hmm.
Some families, whether the financial plan doesn't support it or they're just not interested in making large gifts at this point in time, they think about, well, how can I solve for what that future estate tax liability may be? Right. So we can predict what it would be today if you passed, and we can, project out with lower exemption amounts and a growth rate on your assets, what that estate tax liability might look like. So some families that are saying, I don't want to eliminate it, I want to solve for it, use life insurance in order to do that. So life insurance can be held in another trust structure. It's called an irrevocable life insurance trust. Again, stupid acronym,
Does it have an
ILIT.
acronym?
It does, an
Islet.
ILIT, right?
Perfect.
And that life insurance at the passing of the surviving spouse is income and estate tax free. And so that death benefit that gets paid when the estate tax is due at second death is often what we would use to provide liquidity to pay that estate tax liability. So again, we're not trying to eliminate it. We know it's going to be there, but we're solving for it by the use of an investment vehicle of life insurance. And that can be even more important, Valerie, if we have an estate that's not liquid and we expect
Hmm.
that there's going to be a tax liability. So if I have substantial holdings in real estate, I have a privately held business, I have assets that are not readily liquid or marketable, the ability to have that cash from the life insurance to pay the estate tax, which is due within 9 months. There are some exceptions that are in that tax code for certain types of assets that you may own. But think about 9 months to pay that estate tax. That's where that life insurance can really come into play and be valuable as a tool to cover an illiquid estate.
Perfect. And so let's say you go out and you buy $5 million worth of whole life insurance that at your death will pay out. And you just put it in your name and you put it on the shelf, and now your $30 million estate tax is covered. Why the islet? Why do you need to put it inside of the trust?
Sure. So if I own the life insurance and my wife or my revocable trust is the ultimate beneficiary, that $5 million of death benefit is part of my taxable estate. So now my $30 million estate at my passing is 35 million, and that $5 million of death benefit is going to be cut by a 40% federal estate tax. So by moving the asset into that irrevocable life insurance trust, that's how we keep that $5 million out of my estate and not subject to that 40% tax. Now, going back to your earlier question about the gift exemption and the estate exemption, as
Hmm.
we put premium into that trust, or as we contribute assets into that trust to pay premium, we are making a gift. So we're using a small portion, depending on the amount of the premium, of our gift and estate exemption to get money in there. But by using that smaller portion to get it in, that's what keeps the death benefit, the larger number, from being subject to federal estate tax. And that's where the
Perfect.
design of the policy and working with your senior wealth advisor to figure out how much life insurance you may need and how to structure the premiums in a way that's the most efficient use of your gift and estate tax exemption is so important.
Perfect. So we're not just trying to, pay our favorite estate planning attorney lots of money for no reason. There's a real structure, a real reason for this strategy. And so thank you for helping us understand that. So let's see, gifting. Tell me other assets that are really good for gifting for this situation.
Yeah. So that kind of goes to, okay, Ben, we know the exemptions are scheduled to change in 2026.
Hmm.
Maybe do we just wait and do something, in the next, call it 18 months? Or do we take action now? So, one
Hmm.
of the best assets to gift is an asset that has declined in value. Because once you gift it and it's removed from your estate, the appreciation of that asset is also outside of your estate for tax purposes. So we look back at last year, we had equity markets that were down 18, 19%. Fixed income markets were down over 10%. So we've got assets on our balance sheet that have come down in value. The ability to gift those now and hopefully have them rebound in value outside of our estate is an incredibly powerful tool. Now, fully realize that there's an emotional component that your balance sheet might look a little bit skinnier than it did 24 months
Hmm.
ago at this time. And the thought of gifting may be less palatable today than it was then. But thinking about using these assets that are quote unquote on sale to make a gift, the impact of that growth off your balance sheet and not subject to estate taxes can be incredibly important. Um, the other thing I will tell you about now versus later. So we anticipate, and this is just human nature, that there's a lot of individuals that are listening to this podcast or talking to their wealth advisors or thinking about making a gift between now and 2026. But often, and again, human nature, they plan to wait till the last minute and start this process in earnest in the fall of 2025. I have a real fear that the workload on trust and estate attorneys at the end of 2025 could be so substantial that if you don't start this process soon enough, you may not be able to find a professional to help you get it done. So not saying that you have to go through it start to finish and make the gift between now, and the end of this year, but if this is something that you're interested in, maybe starting to meet with your trust attorney to get a document in place that's going to be sufficient for what your goals and objectives are and have that piece of the puzzle done, and then waiting to make a gift into that trust to the appropriate time that you're comfortable. Again, there may be value in doing it today because the assets are depressed, but if you wanted to wait, all you would have to do is fund that trust structure. And if tax law changes and these higher exemptions are extended, the opportunity cost is you paid your attorney a couple $1,000s to draft a trust that you ended up not funding. To me, there may be value in that versus racing to try and get this done at the end of 2025 and maybe not thinking through strategically the structure of the trust and the assets you're putting in there with as much clarity as you wanted because of that limited time frame.
Perfect. Yeah. And I know the attorneys that I talk to definitely have some price hikes in line for as we're approaching that sunset. So certainly something to keep in mind. So the last thing that I wanted to mention is that really the most of our population is not in this situation. And so what can the rest of us do that, just to help with gifting, or maybe we do want to use our money to help others, but we don't want to be paying a bunch of taxes or have some kind of implications. What other things can we think on?
Sure. I used myself as an example earlier in the conversation. I can tell you, my wife and I do not plan to make a gift of $12.92 million into trust for the benefit of our heirs between now and 2026, right? So, what do everybody else want to consider and want to look at? Well, the first is we have something called an annual exclusion gift. I look at it as I call it a freebie. And right now, you can give as many people as you want $17,000 a year without using any of your gift and estate exemption that we've talked about today. So I could give 17,000 to my children, nieces and nephews, non-related individuals. I could give it to someone I see walking down the street. And that's a way to reduce your taxable estate with smaller gifts. Why our clients like annual exclusion gifts as well is, especially with grandparents, it's a way for you to see your children or your grandchildren receive a gift and how they use it. And that experience that you watch them have, that may help you rethink the basics of your foundational estate plan and how liberal or controlling you might want to be over the residual wealth that transfers to them at death, right? So they kind of get to try it before they buy
Hmm,
it. Um,
very good.
the other really strategic use of that 17,000 has to do with educational funding. So if you want to put assets into a 529 plan for educational purposes for a beneficiary, you can front load that plan with 5 years of that annual exclusion gift. So rather than just being able to put 17,000 in, I could put 85,000 in, which is 5 times 17. Now I lose that annual exclusion for the beneficiary of the 529 plan for the next 4 years. So I couldn't continue to give to them personally, but we get a large amount in the 529 plan up front. that growth is tax-free. And as long as the distributions are used for qualified educational purposes, the distributions are tax-free as well. Recently, end of last year, there was something called the Secure Act 2.0, which actually allowed for 529 plans that aren't used for educational purposes up to a certain dollar value, 35,000, to be converted into a Roth IRA for that same beneficiary. So if you fund a 529 plan for a child or for a grandchild, and they end up getting a full ride to Stanford and don't need those funds, there's still a very valuable use for them with the Roth conversion. And you can ultimately change the beneficiary of the 529 plan to one of your other kids that might not have had the scholarship provided to them. The last thing I'll touch on, and I feel like this is probably the most underutilized, is if you make gifts for medical or educational purposes and you make them direct to the organization, that does not count against your federal gift and estate tax exemption. So if you didn't put a 529 plan in place, but now you want to pay for your grandchildren to go to Stanford, as long as you're writing the checks to the school, you can write them as much as you want and it doesn't go against that exemption. Same would hold true if you had a family member or friend that needed medical care outside of what their insurance covered. You could pay that expense directly to the medical care provider and it doesn't go against your 12.92. So again, just ways to remove assets from your estate on a smaller scale without kind of targeting a $13 million-ish gift.
Perfect. Ben, thank you so much. This is extremely helpful. Before we end today, do you have any other final thoughts? Anything else you wanted to add?
No, Valerie, I just really appreciate the opportunity to come on and share. And I would encourage anybody that has customized questions about themselves and their plan, reach out to your senior wealth advisor and have a conversation.
Absolutely. You've been listening to Your Life Simplified. Be sure to like and subscribe wherever you are tuning in, and we will see you next time.
Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. The views expressed in this podcast is for educational purposes only and do not take into account any individual personal, financial, legal, or tax considerations. As such, the information contained herein is not intended to be personal, legal, investment, or tax advice. Nothing herein should be relied upon as such, and there is no guarantee that any claims made will come to pass. The opinions are based on information and sources of information deemed to be reliable, but Mariner Wealth Advisors does not warrant the accuracy of the information. Certified Financial Planner, trademark, CFP, registered trademark, and federally registered CFP with flame design marks, collectively the CFP registered marks, are professional certification marks granted in the United States by Certified Financial Planner Board of Standards, Inc., also CFP Board. The CFP, registered trademark, certification is a voluntary certification. No federal or state law or regulation requires financial planners to hold the CFP certification.